Well, I think that there's winners and losers right now in the economy, and that's the result of what I would call clashing of three policy pivots slash cycles that are happening. So you have the tariffs that have come up quite a bit, more than any time in a century. You also have immigration policy that's done a U-turn, and underlying all of that, we have this tech boom that's also happening. So what does that mean? Well, it means the economy is adjusting, and certain parts of the economy do look like they're doing worse than other parts. I think the most interesting thing right now is the labor markets. If you look at the details of it, they do look quite recessionary. If you adjust the establishment survey for some of the overestimation issues it's had over the past year or several years, it does look contractionary. But however, despite that, you have consumers, you have real consumption, that is still chugging along. You have real wage growth that is, still resilient around 1%. That's supporting consumption. And you have this AI capital boom that's happening under the surface as well. So there's a lot of on the one hand, on the other hand, not to be a two-handed economist, but it's an interesting economy right now.
And Tiffany, the inflation data that we just received at 8:30 this morning suggests that inflation's kind of in check here. There's nothing really to spook anybody, I don't think. What did you make of the inflation data?
Yeah, I think just taking a step back, we haven't seen this type of tariff adjustment in a century. So there is a lot of uncertainty around just how it would play out. We try to have some sort of historical benchmark, which suggests that, tariffs are passed through to prices. But the reality is when we look at the data right now, what's happening is that companies are passing some of it through, but much less than I think most people expected.
Yeah.
And where you're getting more of an adjustment is lower costs. Companies are trying to manage costs in other places. And one of those places is managing labor costs. And we think the clash of the AI cycle, is also allowing them to manage labor costs. You're already seeing tech, entry-level job hiring at tech firms start to slump. So the labor market is taking on more of this adjustment than I think most people expected.
What's your model number? I'm some fan, I think Jerome Schneider. He's only working like a 3-day work week. His idea long-term is 90-day paper. So you're talking to Jerome Schneider at PIMCO, legend in short-term paper. And Tiffany, you have to talk about the buoyancy of the economy. Is AI discrete, or is the American economy doing better?
Yeah, again, I think if you just look at growth rates last year versus this year, we have seen a clear step down in the pace of growth in the U.S. economy. We were growing, you could call it 2.5% to 3% over the last, not only last year, but over the last several years. And now we've stepped that pace down to what looks like a 1.5% to 1% pace. So clearly the economy is stepping down, but I think what's becoming more clear is that any economist, when you have that big of a move in growth, you have a deceleration in growth, you worry about that momentum. So you worry about the economy stalling. But it looks like, when you look across indicators, we are not seeing a stalling in the economy.
Exactly.
We're seeing growth that's stepped down.
Where is the slowing economy? To me, Paul mentioned it earlier, it's just K-shaped. There's a part of America flat on their back. There's a part of America booming, wealth effect, whatever. You know the drill, Tiffany, better than I do. What does a Fed do? How does a Fed manage the polarity of the American economic experiment?
Yeah, I think that it's a really tough environment to be a central banker, for a lot of reasons. And I think how you balance this, all of these factors, is that you remind yourself, as most of them do all the time, that you're still above neutral policy. You still think you're restrictive, and you do have an economy that has slowed. You have a labor market that has slowed quite dramatically, and you have inflation risks that look less than they did before. And so what that means in our mind is that you can start cutting interest rates. Now because the economy doesn't look like it's stalling, we wouldn't go as far as to say recessionary cuts are needed. But starting that cutting cycle back to neutral makes sense to us. You get more information, you see how the economy is reacting.